The world is being torn in two. We are told a new story every day, a story of a great decoupling, a technological iron curtain descending between two superpowers locked in a silent, relentless Cold War. The narrative is compelling, clear, and seemingly inevitable. The script for this century was written, the United States and China on divergent paths, pulling the global economy apart in the name of security and supremacy. But in the shadow of this grand geopolitical theater, a strange and monumental contradiction was taking place, a move so large it defied the very premise of the new Cold War. Because while the generals and politicians drafted battle lines, the generals of capital, the titans of Wall Street, were executing a maneuver of staggering scale and audacity. Goldman Sachs, BlackRock, JPMorgan, the most powerful financial institutions on Earth, did not retreat from the so-called rival. Instead, they advanced. They orchestrated a quiet, relentless transfer of capital, $1.4 trillion, a sum larger than the entire economy of Spain or Australia. This river of money did not flow away from China. It flowed directly into its heart, into its stock markets, its bond markets, its very financial core. This is the trillion-dollar contradiction. At the very moment the political world preached separation, the financial world was engineering a deeper, more complex connection. This is not a simple story of betrayal or greed. This is a story about a force more powerful than any tariff, any speech, any diplomatic sanction. It is the story of capital's cold, relentless, and amoral logic, a logic that follows its own laws of physics, often indifferent to the maps drawn by nations. So why did they do it? What calculus could possibly justify such a breathtaking bet against the prevailing wind of history? Today, we follow the money. We uncover the three unforgiving laws of financial physics that forced Wall Street's hand, and we ask what this means for the future of this fractured world. This is the great contradiction. To understand this bet, we must first see the board as it was laid out for these players. We must go back to the long, haunting aftermath of the 2008 financial crisis. The West's solution was a deluge of cheap money. Central banks, led by the Fed, unleashed tidal waves of liquidity, trillions of dollars, euros, and yen to save the global economy from collapse. It worked, but at a catastrophic cost to savers and investors. Interest rates were pushed to zero, and then in Europe and Japan into negative territory. You were paying for the privilege of lending money. For the institutions that manage our future, pension funds, university endowments, sovereign wealth funds, this was a quiet emergency. Their models required returns to meet obligations. The returns had vanished. They were stranded in a yield desert, a financial wasteland where the traditional oases of safe income had dried up completely. They were starving, and desperation is the mother of unorthodox strategy. Now, let your gaze turn east. For decades, as China's economy exploded, its financial markets remained a fortress, a forbidden city of capital, opaque, restricted, and governed by rules few foreigners could navigate. But in the 2010s, a shift began. Driven by its own need to internationalize the renminbi and attract stable investment, China began to open the gates. Not all at once, not recklessly, but with precise, controlled intent. They installed sophisticated turnstiles, programs like Stock Connect and Bond Connect. These were not open borders, but regulated entry points, a curated invitation to the world's fund managers. Onto this stage walked three protagonists. First, Goldman Sachs, the sharp-elbowed pioneer, the quintessential deal-maker. For Goldman, China is not just a market, it's a decades-long relationship game. Their bet is on access, on being the trusted advisor for the massive Chinese companies going global, and for foreign companies desperate to get in. They are there for the art of the billion-dollar deal. Then, BlackRock, not a predator, but a gravitational force. It is the world's largest asset manager, a colossus built on passive investing. It doesn't hunt for deals, it embodies the market itself. BlackRock's strategy is simple: own everything in the index. So when global index providers like MSCI decided to include Chinese stocks, BlackRock's mandate was not a choice, it was a mechanical imperative. And JPMorgan, the commercial empire. Its strategy is rooted in utility. Its clients, the multinational corporations of the world, are already deeply embedded in China. They need banking, currency hedging, and financing. JPMorgan's move is to follow its clients and service their every need. It is the indispensable financial plumbing for global trade. If business is happening in China, JPMorgan must be there to keep the pipes clear. Three different entities with three different strategies, yet they converged on the same destination. This was not a coordinated conspiracy. It was the emergent result of individual giants responding to the same signals. And those signals can be distilled into three fundamental laws. The first law is the most primal, the most desperate. It is the relentless global hunt for yield. Recall our yield desert. Picture the capital of the developed world as a frozen tundra. Money was safe, but it was inert. It was preserved, but it was not growing. It was, for all intents and purposes, economically sterile. And then, on the horizon, a new signal flashed. While German bonds offered negative yields and U.S. Treasuries offered a paltry 1.5%, Chinese sovereign bonds offered 3% or more. This was not a small difference. This was a canyon, a 100% premium for what was, on paper, a similar asset, a loan to a major government. For a yield-starved world, this was a siren song of irresistible power. Capital is not sentimental. It is not patriotic. It is a pure vector, seeking the highest possible return for a given level of risk. The political noise of a new Cold War was static, a secondary concern to the screaming primary signal of survival-level need. And so the great thaw began. Money that had been frozen in place for years began to move. It flowed electronically, relentlessly through the new digital turnstiles, seeking the warmth of that higher yield. This was the first and most powerful law in action, the hunt for yield. It transformed China's financial markets from a closed curiosity into a fertile delta rich with the nutrients of foreign capital. The feast, after a long famine, was officially open. But yield alone does not explain $1 trillion commitment. The second law is about something even more intoxicating to the institutional mind, the sheer, undeniable, awe-inspiring force of scale. For decades, global finance had a glaring, absurd hole in its model. Here was the world's second-largest economy, soon to be the largest, home to 1.4 billion people and countless companies, and it was virtually absent from the global portfolio. The game changer was not a political deal, but a financial administrative act. The gatekeepers of global capital, the index providers, began a multi-year process of adding Chinese stocks and bonds to their flagship benchmarks. This was a financial big bang. Overnight, China shifted from being an exotic optional side bet to a mandatory core holding in any fund that claimed to track the global market. You could not be global without it. For a passive behemoth like BlackRock, managing nearly $10 trillion, this created an inexorable imperative. This is not stock picking. This is not a speculative bet. This is the mechanics of tracking an index. To not invest is to consciously choose to be wrong. And so the money flowed, not in a trickle of daring speculators, but in a tidal wave of institutional inevitability. Trillions of dollars of passive capital moving on autopilot, reallocating to reflect the new reality of the index. For any fund manager, professional failure is defined as underperforming your benchmark. When the benchmark includes China and you do not, you are guaranteeing your own failure. The choice is made for you. This is the ultimate promise of scale. It is the final chapter of financial globalization. To be a true global player, you must own the entire globe. The final, largest piece of the puzzle had been placed on the board. Ignoring it was professional malpractice. A portfolio without exposure to the second largest economy on Earth is not a global portfolio. It is an incomplete one. For the titans of Wall Street, leaving that piece out was no longer an option. The scale demanded it. This brings us to the third law, the most intellectually sophisticated and seemingly paradoxical of them all, the diversification imperative. This is where the logic of finance appears to directly contradict the logic of geopolitics. The classic theory of diversification failed in 2008. When the crisis hit, all the developed markets moved in lockstep. They crashed together. There was no shelter in the storm if all your assets were in the same storm system. China presented something new, an economic engine that was fundamentally out of phase with the West. Its financial system is state-directed. Its consumer cycle was at a different stage. It responded to different stimuli. By adding this non-correlated asset, an asset that zigs when the West zags, the overall volatility of a global portfolio could be reduced. This isn't just about making more money, it's about reducing risk. It's about a smoother, safer journey for trillions in retirement savings. But there is a deeper, more profound layer to this hedge. It's a cynical, realpolitik bet on the very nature of conflict in the 21st century. By moving $1 trillion into China, Wall Street wasn't just buying stocks, it was forging chains of mutual financial destruction. It was betting on the theory of mutually assured economic disruption. The theory goes like this. If China's elite, its major companies, and its economic stability are deeply woven into the global financial fabric, then the cost of extreme geopolitical rupture becomes catastrophic for Beijing, too. This $1,400 billion is that padlock. It is Wall Street's premium payment on a form of geopolitical insurance. They are banking on the idea that financial self-interest will create a powerful, wealthy constituency within China that will lobby for stability and restraint. It is a bet that integration breeds not friendship, but a cold, calculated interdependence that makes hot conflict too expensive to contemplate. They are betting that money can build a cage around geopolitical rage.
Now we must apply the cold shower. We must address the glaring, monumental risks, because to present this move as a sure thing is to be hopelessly naive. Wall Street is not naive. They have watched and felt the regulatory hammer fall without warning. Entire sectors like private tutoring were vaporized overnight. The common prosperity drive reshaped the rules of the game for tech giants. This is not a market that plays by Western rules. They operate under the constant shadow of geopolitical flashpoints, opaque security laws, and legal structures that are layers of abstraction from real ownership. This is the idiosyncratic risk of China, the risk that is unique, profound, and impossible to fully hedge. So why do they stay? Why do they double down? Because in their cold calculus, these terrifying risks are not ignored, they are priced in. The famously lower valuation of Chinese companies, the China discount, is the market's way of charging an admission fee to this dangerous theater. Every one of these firms is a high-wire artist. Their entire China strategy is a precarious balancing act performed thousands of feet in the air with no safety net in sight. They are not relying on luck. They use every sophisticated tool at their disposal: deep local partnerships, complex financial derivatives to hedge exposure, legal structures routed through Hong Kong. They are trying to engineer safety. And they have concluded that the potential rewards, the yield for their clients, the fees for their firms, the strategic necessity of being present, outweigh the known calculated dangers of the fall. It is a rational bet, but a breathtakingly risky one. This brings us to the grand, unsettling conclusion. The $1.4 trillion move reveals not a unified world order, but a world operating on two parallel and increasingly conflicting maps of reality. The first map is the geopolitical map. It is drawn by nations for nations. Its primary currencies are security, sovereignty, and strategic dominance. On this map, the story is decoupling, resilience, and preparing for conflict. The second map is the financial map. It is drawn by capital for capital. Its primary currencies are yield, efficiency, and risk-adjusted return. On this map, the story is coupling, integration, and threading deeper connections. These two maps are superimposed on our world right now, and they are fundamentally misaligned. The actions that make sense on one map are insanity on the other. We are all living in the friction of this misalignment. You are living in this friction. If you have a pension, a 401k, or own a broad index fund in your brokerage account, you are not a bystander. You are a passive investor in this $1.4 trillion bet. Your financial future, your retirement security, is now partially tied to the success of this high-wire act. You are betting, whether you know it or not, that financial logic can withstand geopolitical gravity. The bet is that this padlock, forged from trillions of dollars of intertwined interest, is strong enough to hold, that it can absorb the shocks, contain the pressure, and prevent a clean, catastrophic break. But we must be clear-eyed. This is not a moral stance. This is not Wall Street choosing peace over war. This is a clinical, amoral calculation. It is the conclusion that being financially entangled with the dragon is a more profitable, or at least less risky, position than being completely outside its reach. It is a spreadsheet decision. The potential returns and strategic necessities, discounted by the massive known risks, still result in a positive net expected value. Proceed is the only logical output of the model. And so we arrive at the final, haunting question for our century. What happens when these two fundamental forces, the gravity of capital and the tectonics of geopolitics, collide head-on? Can the self-interested, profit-driven logic of global finance truly restrain the primal, survival-driven logic of a rising power and a reigning superpower? Can the wire hold when the storms of nationalism and security rage? The money, all $1.4 trillion of it, is a wager on one answer. It is the collective bet of the smartest financiers on earth that the weight of capital will outweigh, or at least balance, the weight of nationalistic impulse. But history, that merciless teacher, whispers a different warning. It shows us empires, companies, and banks that believed their money made them invincible, only to be shattered by the raw will of states and revolutions.
The lesson is never bet against a state, especially one like China, when it perceives its core interests, its sovereignty, or its very survival to be at stake. The calculus of a nation is not the calculus of a spreadsheet. This, then, is the most expensive experiment in modern economic history. It is an experiment being conducted in real time, with real money, on a global scale. It is testing the very limits of globalization. It is asking whether deep financial interdependence can survive and perhaps even temper a new era of great power rivalry. The titans of finance have placed their bet. They are staking their firms, their clients' wealth, and a piece of the global order on a single premise: that in the 21st century, money, its gravity, its logic, its interconnected web, is the most powerful force of all. We are all, every one of us with a stake in the global economy, passive participants in this wager.
The bet has been placed. The chips are on the table. History will be the judge. We are all about to find out if they're right. If you want to understand more of the hidden forces shaping our world, the economics behind the headlines, the history behind the markets, make sure you don't miss a thing. Hit that subscribe button below. It's the single best way to support this channel and get every new deep dive.